International news now.
Okay, I think it's fair to say that the world was shocked with President Trump's announcement of reciprocal tariffs, although we probably shouldn't call them reciprocal tariffs because they weren't they weren't responding to other countries' details. They weren't responding to other countries' tariff policies. Instead, they were a unilateral, huge upward adjustment in U.S. tariffs. But the world shocked on April 2nd. The rates were much higher than everyone anticipated, and the justification of these rates instantly raised questions about their economic logic and political intent, right? These weren't reciprocal. Instead, they included a baseline tariff of 10% with additional tariffs on 60 other countries. The administration and its advisors talked about and argued that these tariffs were designed to offset other countries' tariff barriers and their non-tariff barriers, which show up as content requirements, currency manipulation, subsidies to export industries, and the big thing in Europe, value-added taxes, which are essentially consumption taxes. And so the administration wants other governments around the world to pull back all these other non-tariff barriers without citing what actually they are. Anyway, there were significant questions raised about the calculation of these tariff rates, whether they were based on a complicated economic formula or instead were created by ChatGPT, or whether they were instead simply the ratio of the bilateral trade deficit over imports divided by 2, because President Trump is a nice guy, in his own words, right? He's trying to be generous.
That's, not really very complicated, but it is a formula,
yes,
right?
It is a formula,
The key thing to say about that is it's not a formula that at all captures some sort of value of what the other countries' policies were, and they said, like, well, it costs this much, and that's how we got this percent. It's more, a reflection of the trade balance, right?
Yes, I mean, this is a measure that targeted bilateral trade deficits rather than trade barriers of other countries. And it's important to recognize, right, that bilateral trade is not just driven by trade barriers. It's also a function of comparative advantage within the global network of exchange. Yeah. So, right, anyway, complicated, multifaceted network, right?
But it's an important point. It doesn't capture the policy part of it. It just captures the trade deficit, and then,
Yeah, and one of the things that we're going to talk about is the trade deficit is frequently a function of the willingness of foreigners to lend us money. Right, that's how we get. It's because of the desirability of investment in the United States that we run huge trade deficits. And so we could run a huge trade deficit because people want to invest in the United States, not because other governments are trying to throw tariff barriers on us. Okay.
And then that it's all unfair.
Yes. Yeah. Other thing that's really
some of it's unfair though.
Some of it we can have a debate about how much
unequal.
We can have a debate about how unfair it is. But the other thing, as Rob mentioned earlier, right, these tariff rates that were announced on April 2nd, they were huge, higher effective tariff rates than the Smoot-Hawley tariffs in 1930. Okay, so let's go next. We've got a slide here of the famous cutout boards that have the reciprocal tariffs, right, that are at half, right, with that baseline 10%. A couple things that I want to point out to here. First, I think note that it's not alphabetical here.
That's the first thing I said. I'm like, how did you organize this chart? Or it's not like the highest tariffs down to the lowest tariffs. Yeah. There's no sensical organization. But
except number one is China, right? And that tells us a little bit about what is perhaps one of the ultimate goals here. The other thing that people seized on right away, and if you like to wear Nike shoes or tennis shoes in general, are the tariff rates on Vietnam, Cambodia, and Thailand. Singled out in each of these respective countries, tariff rates between 35 and 47%. Nike stock tanks on April 3rd and April 4th. Why? Because in response to the prior trade war with China in the first Trump administration, companies in the United States moved their supply chains out of China and move it into Southeast Asia. to get around the China tariffs, and because they want to diversify their supply chains out of China. Well, these reciprocal tariffs were designed to target those strategies. So we're not only going to punish China, we're going to punish companies that tried to adjust to our prior China policy, right? Such as Vietnam, Cambodia,
part of
and
the
Thailand.
reason of that is because China used those countries to kind of get around. Chinese companies use those, right? Isn't that one of the reasons?
Well, I
they're
think
trying
so.
to do?
Yes, the administration wants to blame Chinese companies, but this is also right. This is also American companies responding to those incentives, right? Nike made the intentional decision to move its production into Vietnam to get around it. So it's both. I mean, listen, what are the CEOs of firms, what are they tasked with? They got to make money. Right? And so they're going to go where the prices are cheapest, and that's what they were responding to. All right. So now to get more background on these reciprocal tariffs and the announcement, we're going to watch an overview video from PBS.
Welcome to PBS News Weekly. I'm Lisa Desjardins. President Trump announced a new set of major global tariffs this week, 10% on all imported goods into the U.S., and he escalated trade wars with a second set of tariffs for about 60 countries. During the announcement in the White House Rose Garden, he issued tariffs in response to what he calls unfair trade practices, including a 34% tariff on China, 20% for the European Union, 24% for Japan, and 46% for Vietnam. President Trump called it a historic day, stating the tariffs would revitalize manufacturing in the U.S.
It's our declaration of economic independence. For years, hardworking American citizens were forced to sit on the sidelines as other nations got rich and powerful, much of it at our expense. Jobs and factories will come roaring back into our country, and you see it happening already. We will supercharge our domestic industrial base. We will pry open foreign markets and break down foreign trade barriers.
As part of the announcement, President Trump declared a national economic emergency, which the White House says gives him authority to impose these measures. Congress has the ability to block an emergency declaration, but House Republicans say they will not do so. The fallout of these tariffs, both at home and abroad, was swift. On Wall Street, stocks plunged moments after the opening bell, part of a global decline. Foreign markets tumbled overnight in reaction to President Trump's sweeping new tariffs. But the president this afternoon said he wasn't worried, raising the tariffs as a chance to negotiate.
I think it's going very well. The markets are going to boom, the stock is going to boom, the country is going to boom, and the rest of the world wants to see, is there any way they can make a deal?
But from another high-ranking White House advisor, a different take. Senior counselor for trade Peter Navarro told CNBC the tariffs are long-term and not going away tomorrow.
This is not a negotiation. This is not that.
This as headlines across time zones blared immediate reaction, deeply unreasonable, worse than the worst-case scenario, and warning of a global trade war. World leaders, meanwhile, blasted the Trump tariffs from Europe.
President Trump's announcement of universal tariffs on the whole world, including the European Union, is a major blow to the world economy.
To allies in Asia,
we'd requested the U.S. government review its unilateral tariffs. We are extremely disappointed and regret that they've been implemented.
To a prominent competitor.
China firmly opposes this and will take necessary measures to resolutely safeguard its legitimate interests.
This is Liberation Day.
President Trump declared a national economic emergency when he introduced the tariffs in the Rose Garden just after the markets closed yesterday, insisting time would prove him right.
Every prediction our opponents made about trade for the last 30 years has been proven totally wrong. In my first term, they said tariffs would crash the economy. Instead, we built the greatest economy in the history of the world.
The plan includes blanket tariffs of 10% on all countries that take effect Saturday, as well as what he called reciprocal tariffs, tariffs imposed in response to what Trump sees as a variety of unfair trade practices. Those would take effect next Wednesday. Some of the U.S.'s largest trading partners are on the list, including China, hit with a new 34% tariff, and the EU, hit with 20%. One of the highest tariffs listed was for Vietnam at 46%. Many retailers and brands have moved production to that country in recent years after U.S. efforts to discourage trade with China. Today, stock prices for some of those companies plunged. And some of the tariffs left economists scratching their heads. Example, those imposed on the Antarctic Heard and McDonald Islands, which are uninhabited. Notably left off the list, two of the U.S.'s largest trading partners, Canada and Mexico. The White House says they're exempt from this round for now, but are still subject to other previous Trump tariffs. On Capitol Hill, some Republicans defended the moves.
I want more jobs in our state. I want higher wages for our workers. I want industry that's there to be protected. I want a better deal for my farmers. So if we can get that out of these tariffs, that's great. I don't care what the banks fuss about.
While Democrats universally blasted them.
It's a disaster. There's no economic intellectual foundation. This is a weird digression by Trump. That's number one. Number two, it's going to do nothing but harm to the economy.
Okay, let me highlight a few things from this clip. First, note the messaging around the purpose of the tariffs. They are designed to rebuild U.S. manufacturing capacity and increase industrial employment, at the same time as securing American economic independence. Now, frankly, I don't even know what that necessarily means, but I guess it's just walling off the United States so it doesn't have to trade with other people. But moreover, they are designed to pressure other countries to eliminate or adjust their trading practices, which the Trump administration sees as unfair, that limit U.S. exports. So there's two primary goals. It's to bring back, especially manufacturing industries and firms into the United States, and that will help workers in particular. And then the second one is to spur a renegotiation of terms of trade, right? Now, secondly, I think we need to note the uncertainty associated with the longevity of the tariffs. Now, while President Trump said the tariffs are a starting point for a broader set of negotiations, at the same time, his advisors have repeatedly said the tariffs will be more permanent, and they are designed to encourage global capital holders to make new, very long-term manufacturing investments inside the United States. And realize the kind of dilemma that President Trump kind of has made for himself, I would argue, and that is you can't do both at the same time. You can't have tariffs that are really just not going to be around forever so that they just are used as the starting point for negotiations, and at the same time have those very same tariffs, which won't be around forever, bring back a bunch of new industries, factories, and jobs to the United States, because those are long-term investments that the asset holders are going to not do unless they think that the tariffs are around forever. And so President Trump also says both of those things oftentimes, right? He says, this isn't a negotiation, I'm serious. He tweeted out right after all the market turmoil, stay cool or something like that. He says, my policies will never change. That was one of the posts, and then they changed, right? And so the uncertainty about the duration of the new reciprocal tariffs risk undermining the desired investment effects, the long-term desired investment effects. So, because if global investors think the tariffs will go away, they will be less likely to make those long-term investments, especially in the United States that has such a high wage workforce. Because the only reason to do it would be because there's tariff protections that are relatively permanent to make that kind of investment worthwhile. And third, let's talk about the response by Congress. The video suggests that we have the typical partisan response to these tariffs. Republicans tout their economic advantages about bringing better jobs back to the United States and in rebuilding the industrial capacity, et cetera, and they support the policies of the administration. Democrats sharply criticize the policies on its merits, right? That it's going to hurt the economy and do nothing but harm. It won't achieve their goals, but also that they're sort of random and weird and this kind of aspect of it being that Trump's sort of out of control, right? However, we have seen some surprising opposition from Republicans in both the House and the Senate on this issue. In particular, there's a proposal sponsored by Senator Charles Grassley from Iowa that would effectively create a War Powers Act for tariffs. And we covered the War Powers Act, if you don't remember, but it's basically was back in the aftermath of the Vietnam War, Congress retaking some of its power over using force abroad, right? And so what this proposal does is it does the same thing. It's meant to enable Congress to seize back some of its constitutional authority over tariffs. The legislation would require the president to notify Congress within 48 hours of issuing a new tariff. And then it would require the president to secure congressional approval for any new tariff within 60 days. And if they don't get that approval within 60 days, again, just like the War Powers Act, then the tariff expires, right? And so it's a serious constraint. Now, this bill isn't going to pass. It's very unlikely to pass. Something very much bigger than what we've already experienced would have to happen because of the political composition of the House and the Senate, right? Republicans control both. Republicans are unlikely to pass it. And even if it did pass, because you had some defectors from the Republican Party to support it, the President Trump, has already threatened to veto it, and then Congress would have to overcome that veto with 2/3 majority, and that's incredibly unlikely. So it is important to note, though, that there is some pockets growing. At least 6 Republican senators, for example, have signaled their support for some form of this kind of constraint.
So now let's briefly talk about how the rest of the world has responded to these tariffs. We know that China has escalated the trade war with a series of retaliatory tariffs, and the U.S. has responded in kind. The EU sharply criticized the tariff announcement on April 2nd and began the preparation of retaliatory tariffs, but they weren't implemented, and now there's effectively a pause, what is today, April 11th, between the U.S. and the EU, and the Trump administration, see, we told you so. If you didn't respond, we would treat you nice. And so they're trying to say, hold this out as the carrot, just don't respond to our tariffs and we'll be able to cut a deal. We see this, as Rob just talked about, growing congressional opposition, even from some Republicans, to the tariffs. And we also see rapid deterioration in equity and stock prices, but we're going to talk about that more later. But then, it's important to realize, then on April 9th, Trump appeared to pause, and he'd take actions to end the crisis by imposing this 90-day pause on all new reciprocal tariffs, except those imposed on China. And so we have this 90-day pause, except for China, and that's coupled with the escalation of the trade war with China. The tariff rate on Chinese products now stands at 145%. This is essentially an embargo that will halt all trade between the countries. And then, after Trump basically concedes on April 9th, we see a huge rally in the S&P, almost 10% on Wednesday, April 9th, but then markets gave back, 3 to 4%, I think, on April 10th. And so why did Trump so quickly reverse his policies? We're going to watch a short video here from CBS News that provides, well, it gives a series of reasons, but I think, and we'll talk about this afterwards, there's one principal explanation that focuses on what was going on in the bond markets. So let's go ahead and run that clip now.
So what was behind the president's abrupt turnaround on tariffs?
Pardon me, Margaret Brennan has been working her sources. She joins us now from Washington. So, Margaret, was this a strategy or the president just ad-libbing and going off the cuff here?
Well, Maurice, this was not a grand strategy. I'm told by investors and economists I spoke to today that there were really 3 points of pressure on President Trump. The first is the CEOs of some of the most important corporations in this country, Walmart, Delta, JP Morgan, publicly said there was uncertainty and the chance of a recession. Second, you saw that panic in the bond market. There was concern that foreign buyers might not want to purchase U.S. treasuries. President Trump called the markets queasy. He acknowledged it. And third, Republican lawmakers started to indicate that chaos would complicate their ability to get the votes to lock in those tax cuts the president has promised.
Margaret, the markets went from queasy to up by 8% in the Dow. How do you read that reaction?
A relief rally. Traders saw President Trump blinked. And right now, his advisors are saying it's a victory, but just look at the facts. There are no new trade deals in place. This 90-day pause does not give certainty to a CEO who has to make a decision as to whether it is cheaper to keep a factory overseas or cheaper to move it back to the U.S. Remember, reindustrializing America is what the president said all of this was about. And as for that escalation with China, the Commerce Secretary himself said that there is no contact with Beijing at this point, and President Trump wants to handle it all directly with President Xi himself. No call is scheduled.
Okay. First, let me say, let's note that the journalists here argue that this was not part of some grand strategy or some grand design. Instead, the president blinked, right? She really wanted to say that was a good tagline for her. The president blinked and caved to a series of political and market pressures. Now, as a sidebar, we're going to push back a bit on this assessment that these policies were not part of some larger strategy a little later. But let me just say that this, and I'd like to hear your thoughts. You know, I agree. The idea that they strategized from the very beginning, we're going to trot out these really harsh reciprocal tariffs, and then we're going to pull them back and deal, doesn't really seem plausible because because of what they said and in their statements, but also the interceding crises really it seems like such a strategy that would create that kind of market backlash wouldn't be something that the administration would do, right? And so I get that, but I would say that the adaptation is something that needs to just be sort of accepted on the face of it. That's what the administration has done, is it's fallen back on plan B, I'll call it, right? And so, yeah, I don't think it was a strategy either. I'm not sure I think it matters that much whether it was a strategy or not.
I think there's some elements of strategy in here in the sense that they wanted the tariffs to force other countries to the bargaining table on other issues. And we're going to hear more about this in the next 6 or 7 months. This isn't just about tariff policy. But I think they underestimated the size of the market reaction.
That's what I think too.
Which is frankly a little bit surprising considering they've got, in the Treasury Department, they've got a bunch of investment bankers, people with lots of experience, and they should have known that tariffs of this size were going to create that kind of market panic.
Yeah. So. All right. Second, note the sources of the rapid policy change, right? The president adjusted his tariff policy in response to pressure from big corporate CEOs, the falling bond prices in the bond market, and Congress. Congressional officials were worried and told President Trump that an extensive economic downturn attributable to the tariffs would limit their ability to pass his other big economic platform, and that is that significant tax reform that includes the extension of tax cuts and other additional tax cuts.
Can I add something on this here? And here I want to cite Jonathan Swan, who's a reporter at the New York Times that's well sourced in the administration. He did an interview on The Daily at 5 p.m. on Wednesday, right 5 or 6 hours after this was announced. And so he had talked already with a bunch of administration officials, and he said this was all about the bond markets. Yeah. This was all about the rapid and unexpected collapse in bond prices that pushed long-term yields or interest rates. And that's what the shock was on Wednesday.
Yeah. And third, the video challenges the public posturing around how this reversal was explained. It notes that the reversal undermined the long-run intent of the policy to incentivize more manufacturing investment in the United States, right? If you impose a really high tariffs and pull them right back, especially when it looks like you're doing it in reaction to, pressures, that's going to hurt the long-term incentive that you're trying to produce to bring all these industries back into the United States. And it challenges the idea that the tariff shock facilitated any new significant trading concessions from other countries because no deals have materialized yet. I think that's a bit of an overstatement. Of course, no deals have materialized. You're like 2 weeks in, right? And so there could very well be deals. In fact, that's probably at least my my expectation is that some sort of deal, especially between the United States and partners like the European Union, is going to evolve, right? But right now, they're not all the big promises that everything's going to instantly materialize, and that is kind of the rhetoric of the Trump administration. I think, that's part of the reason that those who are sort of opposed or critical of this cite that kind of thing.
So now we want to spend some more time talking about the broader panics in the global equity and bond markets. And the first thing we want to do is we want to separate the bond and the equity markets, right? And we're also going to talk a little bit about currency markets, right? When you hear stock markets, and so this ticker on the top, I took a picture from CNBC webpage yesterday, so that's Thursday, April 10th afternoon. That's market close on Thursday, April 10th. The equity markets, that when you hear like stock prices, it's usually measured in the United States across 4 indices, the Dow Jones Industrial Average, which is just 30 big companies, the S&P 500, the largest 500 companies. That's a better measure of how the market as a whole is doing. The NASDAQ is heavily weighted to tech stocks. And then the Russell 2000 is a measure of how small companies with small market capitalization, how they're doing. Okay, so that's the equity markets, and then we have bond markets. And here we want to talk specifically about the market for treasuries, which are denominated in different terms, but we're going to talk a lot about the 10-year market, which is when a bondholder lends money to the US government over a 10-year term. Bond prices and yields are inversely related. As bond prices go down, yields go up, which means interest rates go up. And a lot of what happened in the past week was a focus on yields in bond markets. The S&P, this is important, lost $6 trillion, that we talked about this, $6 trillion in value over 4 trading days from April 3rd to April 8th. And this was concentrated in the big high-tech ones. Apple in particular lost $638 billion in market value from April 3rd to April 7th. Why? Because all the production for iPhones and all the gadgets that we like from Apple, a huge proportion of it occurs in China, and it now might be subject to these tariffs. All right, so this is the general story. Huge market reaction, panic, selling of financial assets in the United States. Is this just a simple market correction or something bigger? Why don't we go to the next slide? So here we see, this is, and this was from Thursday, April 10th. This is where those 3 indices were relative to Inauguration Day. So the Dow Jones is off a little over 10%, the S&P down 13%, NASDAQ down 17%, right? So this means and let's just take the S&P, if one of your parents has a retirement, or your grandparents have a retirement portfolio that had $1 million on Inauguration Day, it probably has about $870,000 in there. That means they've lost $130,000 in their retirement portfolio. That's over the span from Inauguration Day to April 10th. But think about this. Think about how many years it took them up to build up $130,000 in retirement portfolio. These are huge, significant losses in equity markets and stock market portfolios.
And the thing to point out, and I think you do raise a good question, is this just a normal correction, or is this something more, of a reaction to policy? There was no real sign before the election that there would be this severe correction like this without some sort of catalyst like these high tariffs. I mean, it's really hard to escape the cause and effect, high tariffs and this crash.
And the way I understand how markets have been moving in the last 6 months is prior to Trump taking office, they were focused on inflation numbers, because inflation numbers tell us about where long-term interest rates are going. So you get a good inflation report, the market goes up. You get a bad inflation report, the market goes down. What's changed since the Trump since Trump administration has come into power is now the key metric that stock markets are following, at least I think what's driving macro trends is new announcements on tariff policies. Yeah. Because that shapes inflation expectations, but it also shapes expectations about economic growth, consumer prices, whether or not we're going to have a recession in the United States. Right. Okay, so now let's go to the next slide, and we want to talk about bond markets here a little bit more, right? And even more troubling development has been in the bond markets for U.S. Treasury securities. Normally, a significant downturn in equity markets, in stock markets, triggers what's called a flight to safety. Investors sell their stocks and they buy U.S. Treasuries because U.S. Treasuries are viewed as the least risky investment in the world. What that flight to safety does is it pushes bond prices up and interest rates go down. And so when interest rates go down, it gets cheaper for the government to borrow and it gets cheaper for us to buy houses and cars and everything like that. Now we see these normal market reactions, this flight to safety on last week, on April 3rd and April 4th, in the 2 days following the reciprocal tariffs announcement. But these trends begin to reverse in the new week on Monday, April 7th. And what we saw was bond prices begin to fall and yields on the 10-year treasuries begin to jump up. And this is really significant because these long-term borrowing rates for the U.S. government also help to set long-term borrowing costs more generally in the U.S. for things like home mortgages, right? And why was this occurring? And did it suggest that there was a deeper problem? Well, beginning on Monday and Tuesday and Wednesday, financial market analysts and observers began to talk more broadly about growing concerns that this could be indicative of a start of a much broader global sell-off in treasuries.
U.S. Treasuries.
In U.S. Treasuries, where that would push the price of U.S. Treasuries down and cause interest rates in the United States to spike. And that could accelerate if everyone around the world started selling U.S. Treasuries. You can go down to the bottom of that slide. This is a huge global market. There is $28.6 trillion in outstanding securities, U.S. bonds. If everyone starts selling those things, the prices go down and interest rates explode. More generally, this raises deep concerns that global markets could freeze up because U.S. Treasuries are the principal financial vehicle that traders around the world use as a reserve asset. So they're worried about bond prices or they're over levered in their stock market, right? What do? They sell US Treasuries to come up with cash. We last saw the beginning of a freezing up of financial markets in US Treasuries. It's something like this in March of 2020, and it necessitated massive intervention on the part of the Fed, not just by reducing interest rates, but expanding its balance sheet to kind of restore what's called the basic plumbing of the global financial system that also restores the dollar position as the primary reserve currency in the world.
I mean, that kind of crisis, you could look at 2020 and you could look at the Great Recession in 2008. Yeah. And I mean, I remember 2008, there was a real fear that the whole economic system was going to come to a screeching halt. You wouldn't be able to use your credit card. You wouldn't be able to get cash out of ATM machines. I think there was a fear that this might spark something kind of like that.
Yes, and the chatter of this began to grow on the Monday and after the weekend on the Monday, Tuesday, and Wednesday. And again, what was happening? The yield on the 10-year Treasury spiked over the weekend by 50 basis points, or basically went from 3.9% on Friday to like 4.5% early Tuesday morning. And the question was, why is this the case? Because the opposite should have been happening. As people were liquidating from equities, they should have been going into bonds, and that wasn't happening. They were also selling in bonds. Okay, as we talked about before, it's this concern about a deeper structural crisis, the plumbing in the international financial network that relies first and foremost on the dollar and dollars established in U.S. Treasury markets that leads the administration to pull back on April 9th.
That's clearly the most plausible. And good. I'm glad they did that, right? I'm glad there is a threshold of pain that they say, now, the cost is too high.
Yeah, and this is significant in terms of revealing information about the pain tolerance of the Trump administration on what it will tolerate in markets, because we found out what that number is, right? And we found out what they're watching, which is what's happening in the Treasury market, because that tells us a lot about the dollar's position as the reserve currency in the world. And again, that sets long-term interest rates in the United States. Okay, the other important development to watch, and we can go back to the slide here, and I was listening to an interview with Neil Kashkari, who's the president of the Minneapolis Fed, on CNBC this morning before we filmed. And one of the things that so he was asked this question about what's been going on in U.S. bond markets, and is there a problem with the plumbing, right? Are we approaching a structural crisis like 2008 or March of 2020? And his response was no. What I think is going on is that there is a shift in the global demand for U.S. financial assets. This is still huge, right? What he's talking about. He's saying that plumbing is okay, but what he's suggesting is what I'm seeing now, and how I would interpret it is we could have a shift in the global preference for U.S. financial assets. Why do I think that? Because we've seen a rapid deterioration of the dollar in the last week. We should have seen the opposite with high tariffs, is his argument. Instead, the dollar is falling against all other currencies. What does that indicate to him? It means that foreigners are less willing to hold U.S. treasuries and U.S. stock, U.S. equities. And so what we've seen is a flood outward of foreigners away from U.S. capital markets. That in and of itself is huge and significant, and it's exactly the opposite of what the Trump administration wanted from these tariffs, which was to encourage more foreign investment inside the United States.
Yeah. Okay, so now we want to shift gears slightly and discuss the rapid acceleration of the trade war between the United States and China over the past week. And as of our filming, the two countries have put tariff barriers in place that will effectively halt all trade between the two economies. So after the United States, just to refresh, right? After the United States raises tariffs on China's exports to 145% on Wednesday, April 9th, the Chinese government raised its tariffs on U.S. exports to 125%. Spokespeople for the Chinese government also stated that China would ignore and not respond to any future tariff hikes by the United States. Not because they are giving up, but they just note that any additional tariffs no longer have any economic significance.
That's a quote.
Yes, because current levels make U.S. exports to China not financially viable. And so we're at the point of such high tariffs that you could say, okay, we're going to raise tariffs by 1,000%. It doesn't matter. Yeah. You're already past, there's no trade anymore.
And can we say something else on this? If one of the purposes of the tariffs is to generate government revenue, you can't generate tariff revenue if you don't have any imports. Yeah. And so by raising the tariffs this high, it means that all this tariff revenue is going to collapse.
Right, and so that revenue to the U.S. Treasuries, which was one of the goals, right? They're like, we're gonna, get rid of the deficit this way, or at least reduce it, right? It is, and realize who you're doing this to. You're one of your largest trading partners, so it's not like some little country that we could go without.
Yeah.
Pretty
in
much.
terms of largest trade partners, Canada, Mexico, and China.
China,
yep.
And we'll see how much trade is with Canada and Mexico, depending on how high their tariffs go, right? And so yeah, that's disjuncture, we'll call it. Again, these are huge economic changes. China, as we were saying, is the United States' third most important, biggest export market. U.S. exports to China support about 900,000 jobs in the United States. The U.S. exports just under $20 billion of agricultural products to China. And all of that agricultural exports, that's going to stop. Texas exported about $25 billion of products to China in 2023, mostly agricultural and petroleum-based goods. Again, all of that's likely to stop. And so these tariffs and the reciprocal tariffs are going to affect specific sectors differently. And the ones that are going to be affected in terms of exporters in the United States, there's going to be agriculture and natural resources like petroleum and things like that. And then it's also going to affect consumers. Because even though the reciprocal tariffs are gone and so the inflation won't go up that much, high tech like iPhones and the price of those, you should probably buy one soon. In fact, I am seriously considering.
I'm going to buy one this weekend too.
Yeah.
Ours are old, but
because there's just no escaping the idea that that price is going to jump up significantly. I've seen some reports that really high, right? And so
$2,000-$3,000
for an iPhone.
I heard stories on CNBC this week that Apple has been flying like 747s full of iPhones from China to the United States to try and get as much product and inventory as they can in the last week.
Smart.
All right, so we want to talk about a couple things with
So this is a huge trade war. Trade's going to stop between the United States and China.
And so let's talk about the first we can think about this, the trade war with China as an off-ramp to the reciprocal tariff trade war that sparks this broader panic in bond and trade markets, right? And the idea here is that the administration's coupled de-escalation with an escalation of the trade war, and it's making these concessions to the rest of the world more tolerable politically by saying we're escalating against China, and China is the real enemy here. And
it does sort of play into, this was a strategy all the time because it shows who the really bad actor was. The only one that really retaliated was China. Now we can focus and everybody sees, right? I don't buy that actually is what happened, but it doesn't, again, I don't think it really matters. In terms of selling the new version.
It's a way to claim political victory, right?
Sure.
And so all his advisors come out and say, this was the classic case of the art of the deal. And say, well, see, we're fulfilling the broader goal of reindustrializing the United States because we are cutting off trade with China, okay? So potential for a PR win, but we'll see, because yesterday in the markets, they didn't like it because they understand, still high tech, it heavily depends on China. And we still got to deal with the long-term costs associated with it.
And inflation is still going to get fueled by this.
Yes.
Right?
Yeah.
I mean, and the tariffs didn't go away, right? There's still that base 10% that's going to fuel inflation.
And the potential uncertainty that base 10% can go up if other countries don't make significant concessions to us.
But I do like this political argument that ending the reciprocal trade tariffs on the rest of the world in reaction to the crisis that was sparked, that they had to do something, but then doubling down on China. That's a pretty effective political move because you can defend that. There's a lot more bipartisan domestically in the domestic politics of this, because there's a lot more support for tariffs if they are targeting China. So popular support will be higher on just a China-specific trade war. There's Democrats who also favor getting tough with China, right? It's very popular. The Biden administration was really tough on China, and so that's going to make it easier too.
Do you want to talk? So we were going to talk about two more aspects of this. Do you want to talk about preventive economic war, or do you want me to do war of attrition first?
Let me do the preventive war, because this is just another way of looking at this. So one way that I started thinking about this is if you think about a trade war as just a war, perhaps this is part of the strategy of the Trump administration, is that this is more or less a preventive war, that the United States in this scenario is the declining power, but still a, right now, stronger economy than China. But over time, that's going to get harder and harder, and the balance is going to come up, and China's going to keep rising and keep growing and has more room to grow than the United States and has certain advantages. Now is the time to try to sort of break that dynamic. If you're going to fight a trade war with China, this is probably the last chance that the United States could win a trade war with China, at least economically, right? I think that there's a lot of political reasons why China could outlast the United States, but just thinking about economically, China has had a struggling economy the last several years, right? It faces some real structural problems, and this could push it even further sort of over the edge. So you can do real damage to the Chinese economy that might be worse than the damage that will happen to the American economy, just in terms of straight economic, consequences. So perhaps that's part of this strategy too, is to hit at what both the Biden administration and the Trump administration and pretty much both parties see as the chief adversary to the United States, and that's China. This is basically could be seen as a preventive war to kind of cripple China.
Yeah, right. And to decouple the U.S. economy from the Chinese economy when the U.S. is still in a better position.
Right.
But again,
doing that later is not going to work.
Right. And the logic here is there's a long-term commitment problem. China can't reassure the United States that it will continue to benefit from further integration in the Chinese economy.
Right.
But again, it's costly for everyone.
Right. I mean, I'm not advocating this. Like, this makes it all worthwhile. I'm not saying that, but I do think that this is part of the strategy.
And there was a deal. There always is a deal. But the deal just got harder to get in the last week. Okay. Another way to understand this is, and economists have talked about it, an economic war of attrition. So we can put up the slide, right? And an economic war of attrition, and the decision to engage in a war of attrition, where you're fighting a war to, imagine two heavyweight boxers, and they just take turns punching each other. And the question is, who can tolerate more pain? And whoever can tolerate more pain, that's the winner, right? And so the question here with an economic war of attrition is, who can sustain the cost of the trade war longer, right? We've got both leaders expressing an unwillingness to concede, right? And they also recognize that there are sharp costs to each. Both sides are paying daily costs, right? This is the heavyweight blows in terms of lost trade, higher imports and inflation, falling equity prices, higher employment, lower economic activity. Now, when you're waging, though, a war of attrition, you're essentially making a bet over how long can I stay in the fight, how long am I going to be able to stand in the ring, and how long do I think the other side is going to be able to stand in the ring. Because if you think the other side is going to be able to stand in the ring longer, you might as well concede on day one. Because what's going to happen? You take 50 punches over 10 rounds, and then you still get knocked out. However, right, if you think you can last longer, then you stay in the ring and you wait for your opponent to capitulate. So then why do we have these wars of attrition? Well, economists argue that we get these wars of attrition when we have fundamental uncertainty over each side's pain tolerance. And so they don't know right now that what they would say here is the US and China know they're going to exchange blows, know they're going to take costs, but both sides are uncertain about the other side's pain tolerance, and both sides think they can last longer.
Exactly.
And so now we've got a war of attrition that hurts everyone.
And both have reasons to think that they can last longer. China thinks it can last longer because they think they might have a smaller and weaker, more vulnerable economy, but they have a higher pain tolerance. That's clearly what President Xi is counting on, is that but the United States thinks they can outlast China because they've got a bigger, more robust economy. And, it's unclear which one of those sets of assets are going to win out. I know what I think, but
Well, but what's a negotiating challenge here for Trump now, right? He just sent a powerful signal about the limits of his pain threshold, right? He revealed information. He's unwilling to risk a collapse in the global bond market. But then we got to ask, well, who can sell bonds? China. Right? China is sitting on $800 billion in U.S. Treasury bonds. They have the capacity to press that Treasury market. And, there isn't good data on this yet, but I wouldn't be surprised to find out that they have been selling some Treasuries in this past week.
Because that could affect the bond market.
Right. And so we have this so if we get a war of attrition from uncertainty, note that we've got important information being revealed, right? And so more broadly, if you want to understand what's going to happen in the global economy and what in terms of tariff prices and when deals gets constructed and how bad this trade war is going to go with China, my advice is watch the Treasury market.
Right. Now, let's be clear. China selling off a bunch of its U.S. Treasury bonds would hurt China too,
yes,
right?
Absolutely.
And so it's not like some silver bullet that they can just do to us, right? Yeah. They would be hurt severely too. Yes. So it's unclear. That's where the uncertainty keeps going. It's like, well, they wouldn't really do that because.
Well, and the challenge for China is if they're selling off the Treasury bonds, that's going to push up the value of their currency relative to the dollar, which will then make their exports less competitive, which makes it harder for them to export their way out of, right? So at the same time that they get shut off for the American market and they're looking for alternatives, but if their currency goes up, then all of a sudden their exports are less competitive in other markets. So this is why if you watch financial guys who are managing big investment funds, they're less concerned about the dollar's position as a reserve currency because the basic argument is there's no place else to go.
Yeah.
We don't have markets that are deep enough, and no other government has markets that are deep enough to provide this reserve asset. Okay, so we want to finish here, and I'm going to have to kind of rush through this because I want to be conscious of time here about a kind of grand strategy explanation for what's going on. And I want to talk about what's been labeled as the Mar-a-Lago Accord. And it's important to realize there's been a lot of chatter about this in the last couple of months. And investment banks are now advising their clients based on an assessment of saying this is what administration policy or the grand strategy could look like. And investment banks are advising them, you might want to think about this when you're trying to figure out how to make money in the next 3 or 4 years. And this is a grand strategy explanation for the tariffs. The reciprocal tariffs that were announced on April 2nd are not just about trade. Instead, the argument here is the Trump administration wants to reset the global economic order and the global security order. As a result, this is an opening salvo in a complicated mix of trade, industrial, currency, and alliance policies. And if you want to learn more about this, Stephen Myron, who is the current head of the Council of Economic Advisors, wrote an important policy brief in November of 2024 that essentially talks about a Mar-a-Lago Accord. But more generally, it's an argument about how the United States and what policy tools the United States might have at its disposal to reset the larger global order. So again, my remarks here are based on that document and based on how people have been talking about that document in the last couple of months and how the actions of the administration in the last couple of weeks become a little bit more explainable in terms of this document. All right, so let's go to the next slide. What's the argument here is that there are deep structural problems in the international system associated with U.S. leadership in a free trade system that was created after 1945. What are some of these problems? The U.S. has huge trade deficits, which are indicative, they argue, of unfair trade around the world. So they indicate that other countries are cheating and throwing up protectionist barriers that harm U.S. exports. The result of this structural imbalance is the long-term offshoring of U.S. industry and an American dependence on imports. And so it's blue-collar workers in the United States that have paid the costs of the free trade order of 1945. And instead, what happened, particularly after the China shocks in the late 1990s, is we've seen a steady erosion of U.S. manufacturing jobs in the United States. And so it's blue-collar workers that have paid more for the cost of U.S. economic and political leadership. And so we have to, and the argument of Myron is we have to force the rest of the world to offset these costs and to help and to pay back the manufacturing sector in the United States. The other thing that's an element of this structural imbalance is that the world relies on U.S. trade deficits and government budget deficits to supply the reserve currency, Treasury bonds. Again, we mentioned this is a $28 trillion market for U.S. Treasury bonds. And so here's the paradox. The world needs the dollar as its reserve currency, and the world needs the U.S. government to run budget deficits to provide this reserve currency. And what Myron and Trump are arguing is the world needs to compensate the United States for providing these public goods of running budget deficits that provide liquidity to the system, right? But there's another challenge here. The demand for Treasury bonds increases the value of the dollar in currency markets. And as the dollar goes up in value, that means U.S. exports become more expensive, which this structural position of the U.S. as the reserve currency and the dollar as the reserve currency then reduces the competitiveness, the long-term competitiveness of U.S. exports, which puts more of the costs of leadership on the American manufacturing sector. Now, Myron argues that all of this economic system is coupled with structural problems in the global security order. Allies undersupply their own security and free ride on U.S. military protection. And so allies need to increase defense spending and increase compensation to the U.S. for its military power. And so what Myron argues is that we can fuse all of this together and get the rest of the world to manage a coordinated devaluation of the dollar, while at the same time getting the rest of the world to subsidize American security and military protection of the world.
Cost sharing is the way.
Cost sharing, right? But make no mistakes, this is designed to create a much larger transfer of wealth from the rest of the world to the United States. And so when you hear President Trump saying, this is all going to be great, they're going to be giving us lots of money, this is what he's talking about. He's talking about compensation to the United States for the dollar's position as the reserve currency and for the American alliance umbrella. Okay. So what are some of the policy responses that can remake this global economic order? We can, Really what Myron is talking about in that document is we need to fuse trade policy, industrial policy, currency policy, and security policy. And we need to externalize some of the costs, a large portion of the costs that the U.S. taxpayer, and in particular the blue-collar sector of the United States, has been paying for the security order over the last 80 years. Phase one, we're going to use tariffs to begin negotiations and to begin to rebalance global trade. And this is the standard argument that you've heard about. We're going to put on tariff barriers. Myron uses the number 10% in that document to suggest that 10% would be non-inflationary. That's why I think it's no accident that the pause on April 9th fell back to the 10% on everybody except China. But again, what are tariffs? Protection to enhance domestic employment, encourage domestic investment. This is going to reduce imports. He argues that the tariffs will pay for themselves, and this is where one of the contradictions, because we should see an appreciation of the dollar, which would then enhance the purchasing power of American consumers. And more broadly then, we're going to leverage this opening tariff round of tariffs and access to the American consumer to pressure states into more comprehensive negotiations about other things, like alliance burdens and the position of the dollar in the international financial system. All right, so we can go to the next slide. Then in later phases, what Myron talks about is we need to construct a multilateral currency arrangement that facilitates the coordinated devaluation of the dollar. And so we want the dollar to devalue to enhance U.S. export competitiveness so the U.S. can sell more of its goods around the world. But here's a risk and here's a contradiction. The devaluation of the dollar potentially undermines its reserve currency status and risks raising public borrowing costs. We've seen that in the bond market reaction this week. And so what does Myron say? And this is where we can start to think about what's the grand deal and what is the U.S. really moving to. What Myron talks about is pressuring official holders of U.S. bonds. These are central banks around the world that are holding treasuries as a reserve currency to protect their financial system from chaos. The U.S. should pressure the public holders of U.S. bonds to alter the term structure of their debt, to move away from 3-year treasuries, 6-month treasuries, 10-year treasuries, 30-year treasuries, and replace them with what are called century bonds that are non-interest bearing, i.e. they would take their 10-year treasury bonds and the U.S. is going to give them century bonds where they don't pay interest on. And so what is Myron arguing in there? The U.S. should use tariffs to pressure other governments to lend money without interest to the U.S. government. And this is the vehicle to support the dollar as the reserve currency, but also the vehicle to pay for the U.S. security umbrella without having American taxpayers to do this.
Right. And in their minds, this is a fair deal because, that's how we get the rest of the world to pay their fair share, so to speak. Now, from the other side, they're just saying, okay, we already hold these bonds that accrue interest, and we're just going to give you and replace them and not get any interest. Exactly. Why would they say yes to that? Well, they might say yes to that if you say, and if you don't, tariffs.
Yeah, well,
That-
yes, that's what the Trump administration and his advisors think. But think about this: if you're a democracy in the United Kingdom or France or Germany, essentially what the U.S. is telling you is, we want you to hold Treasury bonds without interest. This would be a direct transfer from those countries to the United States, like foreign aid, right? And how is a democratically elected official in these countries going to say, yes, I'm just going to transfer a bunch of money to the U.S. taxpayer? Think about the politics of how hard that would be around the world.
Well, you can see it already, right? Who's the most popular president in the world right now? The president of Mexico. Why? Because when the tariffs started, she stood up to Trump and criticized them, and then she gained a lot of domestic support out of that. That's the dynamic you're talking about, right? That's what would happen.
Yeah, it's going to be very hard for democracies around the world to cave in the way that administration officials expect they're going to cave. Let's go back to the slide. The other kind of strategy that the administration wants here to do and is hoping with this is, we want to essentially divide the world into buckets of allies, adversaries, and neutral. Right, and they want the allies to subsidize U.S. borrowing costs to reduce the cost of military protection on American voters, and that's what this is. And Scott Bessent, the Treasury Secretary, this is one of his talking points. Let's divide the world up into buckets, and let's identify who's with us, who's against us, and the people that are with us, they need to pay more for what we're providing.
Right,
okay.
But then they don't get tariffs. But
and
the adversaries then get the big tariffs.
Yeah, exactly, right. And so the carrot of all this is, if you're in the umbrella, you get American military protection and you get reduced tariffs.
If you're outside of the umbrella, you have really high tariffs and you get punished, and you don't have access to the world's hugest consumer market.
Yeah, let's finish the final slide here. And this is Myron's, the final paragraph of that paper, right? And so on the one hand, I said at the beginning of class that I feel like I have a better understanding of what the administration is trying to do. But we haven't talked about whether this is feasible or not. I think one of the things, we can look at how financial markets and the rest of the world have responded. This raises some questions about the feasibility. It's important to recognize that the author of this document that uses the phrase the Mar-a-Lago Accords, and I should say, the plan here is we get this global shock. And where does that name Mar-a-Lago Accord come from? We get a global shock, and then everybody comes, the key players in the international system come to Mar-a-Lago to negotiate a comprehensive multilateral currency arrangement that has this gradual devaluation of the dollar with President Trump. That's why it's called the Mar-a-Lago Accord. But this is where we need to finish up, right? The final paragraph of that document. There is a path by which the Trump administration can reconfigure. Think about this. This is a structural shock. He's making an argument to remake the structure of the international system. There's a path to reconfigure the global trading and financial systems to America's benefit. This is important. Here's the qualification. But it is narrow and will require careful planning, precise execution, and attention to steps to minimize adverse consequences.
Right, and so the
you can take the slide off.
The huge reciprocal tariffs that then sparked the crisis in the bond market that spooked everybody, including the Trump administration, to pull it back right away. That is not a well-planned, cautious. No. The problem with it, but it's important because it reframes the whole discussion about is he just going with his gut, and is this chaotic? It reframes that to that, that kind of approach might have been the crucial mistake that kind of derails the whole plan, right? Because once you reveal all the information that you were saying about, well, we're not going to do this if it, upsets the bond market too much, then, you just narrowed your path even more, right? Yeah. Because there's a lot of moving pieces to this.
There's a lot of moving pieces. It's incredibly ambitious. And again, they're being transparent. And we haven't talked about territorial expansion and everything. This is a broader attempt to remake the international order, right? And it's already facing significant resistance 2.5 months in.
And you think about this, and the plan B fallback with just a trade war with China doesn't get to this necessarily, right? You could, because I think that it's going to be hard to corral all these allies to do what we want them to do.
Yeah, but that your point tells us the next 90 days are really important because this is where, if he has any leverage left, he's got to get concessions in the next 90 days.
From his allies.
From his allies.
Yes.
Yep. So, all right, that's
and
all
that,
we.
You know, that's potentially that's what they're going to be working on over the next 90 days.
Yeah.
Is trying to figure the.
And then we have to
cut
think
the deals.
Yeah, and then we have to think about what they can tolerate domestically in a bunch of democracies. So that's all we got. It's been a busy semester. Thanks for following us. I hope we've helped you to kind of understand what's happened the last 3 months. We're going to be back at this in the fall, right?
Yes.
And we will post, we'll be doing more explainers like this. We'll post them on YouTube. But otherwise, good luck on your exam and have a good summer break.